Hi, this is Professor Joel Litman. I want to talk about today the reason and the data behind why U.S. stock market is not headed for a massive bear market, and probably the U.S. is not anymore headed for a recession now in July of 2024, and why China is in deep, deep, deep trouble, and the data is showing it. The data I want to show today that's backing this up is the intrinsic credit default swap. Those of you that know me and seen my other videos know that the intrinsic credit default swap is one of the most powerful signals that you can have to tell you where the equity markets are headed, because you can see in macro what's going with default risk at companies. So let me show you this slide. This is from 2019. One of the reasons the US did not have such a problem, US companies, meaning the US stock market did okay in 2020 during the pandemic, did really well in 2021 coming out of the pandemic. One of the reasons was the balance sheets of companies were so strong going in. And by that, we mean the intrinsic credit default swap, the best indicator of whether or not a company is headed for bankruptcy, was unbelievably low for all US companies. If you take a look at this chart, you can see that 25% had an intrinsic CDS of less than 1%. That means the risk built in, the cost of the risk, is only less than 1% above the US Treasury. Well, that's saying there's almost no chance those companies are going to go bankrupt. 75%, that light blue area, were 100 to 409 basis points. That means pricing the risk of their debt would have been 1% to 5% above, which means somewhat safe still. This is a very safe area. So when you're looking at this, you're saying 98% of companies, 98%, were safe or somewhat safe based on an intrinsic credit default swap in 2019, and only 2% had real concerns or real issues. When you look at 2021, yes, because of the pandemic, there were a lot more issues. There are actually now 6%, so triple the amount of companies that are riskier junk, where their credit default swap, their intrinsic credit default swap, would have been priced at 500 basis points or above. That's 5 percentage points or above, which means very, very strong, more likely risk of default, more likely to go bankrupt. That tripled. But 6% is still a small number. And by the way, that's not the number that actually went bankrupt. That was the number that were at risk of bankruptcy. The number of companies, public listed companies that actually went bankrupt, was a lot lower than that. Much, much, much lower, right? That said, right, the fact that the riskiness went up means the cost went up, and it does say that things are going to be a little bit concerning when you go into 2022, because that's how the balance sheets look in 2021. But otherwise, still a very safe U.S. market. Another reason to say why we've been so long the U.S. stock market, really since the bottom of the pandemic in 2020. Now, if you look at 2024, despite all the discussion about recessions and all the problems, yes, all right, maybe 31% are in the super safe area. 68%, the light blue, are somewhat safe. Now, some of those are pushing towards 500 basis points or 5 percentage points, which would be a little bit worrisome. But from 100 to 499 basis points, you're looking at very safe companies that are getting a low intrinsic credit default swap and therefore a low amount of risk. But here's the kicker. Literally, right now, only 1% of all publicly traded U.S. companies, 1%, right, it's actually 1% or less, actually have an intrinsic CDS above 500 basis points. That means the risk of default of publicly listed companies, the risk of bankruptcies of publicly listed companies in the US, is at a lower level than it was pre-pandemic. It's at a lower level than it was in 2021. In fact, it's one of the lowest levels we've ever seen. It's some of the healthiest balance sheets we've ever looked at. So the idea that US public companies are going to go into a massive bear market when you have so little risk of default says that you're going to have a bear market with no bankruptcies. Well, that's not what happened in 2008. That's not what happened in 2000. That's not what happened in 1991 or 1929. In fact, every major equity bear market the United States has ever had, you've had very high intrinsic credit default swaps, lots of companies that are trading with these high intrinsic CDSs, meaning likelihood of bankruptcy, and nothing like a pie chart that looks like right now. So the idea that the US stock market is going to go into a problem right now, given how safe the balance sheets are of US public companies, is just silly. I'm not saying we couldn't have a correction. The likelihood of a bear market is very, very low. Now, let me show you China right now. Fully 1/3 of every public listed company in China, I'm talking about 5,000 plus public listed companies, has an iCDS above 500 basis points. That means 1 out of 3 companies is at risk of default. is at risk of bankruptcy, is at risk of not being able to pay their debts, not be able to make their lease payments, their rental payments, or whatever kinds of payments they have and obligations, whether they're off balance sheet or on balance sheet, they're at deep, deep risk now. 2/3 are okay, but it's that 1/3 that we're looking at. During the Great Depression, 1929, maybe 20 to 25%, maybe as many as 20% of US public listed companies actually went bankrupt. You're looking at China where you could have a situation where fully 1/3. And if these companies do go bankrupt, that will bleed over into the safer companies and at least push them towards some unsafe areas. So what we're seeing in China right now is an absolute potential collapse. What we're seeing in the United States is a very, very, very healthy economy. That means keep your money invested in US equities over the long term, and stay out of the Chinese equity markets if you know what's good for you. All right, that's a quick bit for today. Thank you so much. I'm Professor Joel Litman. If you like more, subscribe and like our channel.